It's a market truism that 90% of investment decisions are driven by emotion, not data. And when it comes to small cap investing, that emotional roller coaster can lead to big mistakes. The most successful investors, they rely on one thing above everything else, and that's conviction. Having conviction in your investments is what keeps you from selling too early or panicking during a downturn. It's your anchor when volatility strikes. And in the small cap space, it's not an if, it's a when volatility strikes. At the end of the day, conviction is not about blind loyalty or being stubborn. It's not about holding on to a position no matter what. It's about sticking with an investment until the facts change or until you find a more compelling set of facts. That includes corporate developments, competitive dynamics, and even broader macroeconomic trends. The key is to stay curious and stay informed. Small cap investing is not for the faint of heart, but with the right process, deep research, and yes, conviction, it can be incredible. Number one on our list in building conviction is knowing what a winning stock looks like. So as we said before, we look for companies with low valuations, high revenue growth, high margins, and underappreciated optionality. Having a repeatable process helps cut through the noise and eliminate some of the cognitive biases you might suffer from when you invest in small cap stocks. In any investing, having a long-term view is critical, and that's especially true in small caps, which can have more volatility than other stocks. Real value will take time to unfold or be recognized in the market, and short-term share price volatility can easily distract you from your investment thesis and either cut profits too early or sell at a small loss. And if you do that, you're unlikely to outperform in the long run. People often obsess over company fundamentals when they're investing in small caps, earnings, margins, growth, and certainly we do too. That's core to our thesis. But in small caps, the macroeconomic backdrop will make or break your investments. We follow three macro factors very closely when we're managing our small cap portfolio. Interest rates and direction of interest rates, economic growth cycles, and market liquidity. Small caps often rely on external financing, so higher interest rates mean tighter capital and more expensive debt. Both of those things can quickly derail growth for a small company. Our most objective measure of liquidity in Canadian small cap markets is literally that. We will measure the dollar value liquidity of shares being traded on a monthly basis for the TSX Venture and the CSE combined. And what we've seen is that in a bull market, that liquidity will go up by over 800% in a 12-month stretch, which is a huge flow of capital coming in. And when that capital decides to leave, it will collapse by 80 plus, sometimes 90+% over 24 months. And if you don't know where you are in that cycle, you very likely could be buying things at the top of the market. And that's when people really get a bad experience investing in small caps. So have some sort of objective measure of where you are, and it will help you immeasurably in being successful in your investments. So in small cap investing, fundamentals definitely matter. As we've talked about before, revenue growth, margins, management teams, but macro really sets the stage for whether you could be successful investing in the company or not. So if you're serious about small cap investing, you need to know where you are in that macro cycle. And that's where we come in. If you want to learn where you're at, give us a call. We're happy to share what we've got.